Welcome back, everyone, to the deep dive. Today, we're going to be looking at something pretty interesting, HDFC Bank's Q3 FY25 results.
Yeah, we've got a whole bunch of stuff here. Press releases, financial reports. We even got some very well-designed slides from their investor presentation.
We're going to try to figure out what it all means, right?
Yeah.
Like beyond just the surface level. What is HDFC's, strategy? What are they doing? Where are their challenges? And what can these numbers kind of tell us about, where they're headed in the future?
Yeah, I think the really interesting thing about HDFC is just how many different businesses that they're in. It's not just the bank itself. I mean, they've got subsidiaries, they've got a life insurance company, they've got an asset management company.
It's a whole world.
Exactly. So we're going to try to kind of unpack all of that.
Yeah, so let's just jump right into it.
Yeah.
Right off the bat, HDFC announced a consolidated net revenue of $652.8 billion.
Yeah.
Which is, that's a billion with a B. That always gets my attention.
It definitely catches the eye.
But the real story, I think, lies in their consolidated profit after tax, which grew by 13.1% after adjustments. And that's got to be a good sign, right?
It definitely suggests that, their core business is healthy. And I think what's interesting here is they're making adjustments for, things like trading gains and prior provisions and tax credits. So what they're trying to do is show you what the underlying strength of the business is.
So it's almost like they're saying, hey, look at these numbers, but, just so you know, we're taking out this stuff that maybe isn't like the day-to-day of what we do.
Right. Yeah, I think they're trying to be transparent with the investors and say, look, we could have left all that other stuff in there and it would have looked even better. But we want to show you really what the core earnings power of this bank is.
Yeah, it's like don't get distracted by the shiny objects kind of thing. Focus on the fundamentals. So while that big revenue number got my attention, it's really that adjusted profit growth that tells me kind of, how well they're running the machine.
Yeah.
So before we get too deep into the consolidated view, though, let's zoom in on HDFC Bank's standalone performance.
Yeah, I think that makes a lot of sense. Because when we look at the consolidated view, we're looking at all of the subsidiaries as well. But the standalone performance really isolates the bank itself. So looking at that, we see 6.3% year-on-year growth in net revenue, reaching $421.1 billion. And if you really dig into the components of that revenue, their net interest income, that's money that they're making from lending money that grew by 7.7%.
Okay, so their bread and butter is doing well.
Mm-hmm.
But one of the things that really jumped out at me was that fees and commissions income surged by 17.9%, hitting $81.8 billion.
Yeah.
I mean, that's a significant leap.
Yeah. It really is. And it suggests that, they're not just relying on that traditional lending business to drive their revenue. They're diversifying. They're maybe expanding into new service areas, offering more fee-based products. It'd be really interesting to compare this growth to what their competitors are seeing and see if this is, is this an industry-wide trend or is HDFC really outperforming here?
Yeah. Are they just riding a wave or are they, really paddling hard and outpacing the pack?
Yeah.
Okay, so let's talk about balance sheets. I always, whenever we get to the balance sheet, it's like, okay, time to put on the serious financial hat.
Yeah.
Their total assets are a mind-boggling.
Mm-hmm.
37,590 billion. I mean, I can't even conceptualize that number.
It's hard to wrap your head around a number that big, right? But what we really want to focus on, I think, within that massive balance sheet is their deposit growth. Their average deposits grew by 15.9% year on year, reaching $24,528 billion.
Okay, now that is a lot of trust being placed in HDFC Bank.
Yeah.
But why is that number so important? I mean, I always think of a bank as, the main thing they do is they lend money out.
Well, they do lend money out, but those loans have to be funded somehow. And deposits are really the lifeblood of any bank. They provide the raw materials for lending activities and other investments. So when you see deposit growth like this, it really speaks to customer confidence and the stability and the financial strength of HDFC.
Okay, so more deposits means more fuel for their lending engine. Which brings us to the loan book. And this is where things get a little bit more interesting.
It does get a little bit more interesting. So when we look at the breakdown of the loan book, we see that retail loans grew by a healthy 10%. Commercial and rural banking loans grew by 11.6%.
That sounds pretty good. But then I noticed corporate and wholesale loans actually decreased by 10.4%. What's going on there? That seems like a pretty big shift.
Yeah, I think it's a deliberate strategic move on HDFC's part. There could be a number of factors driving this. They might be concerned about the overall economic environment or, certain industries in particular. So they're taking a more cautious approach to lending to corporations. At the same time, you see that growth in retail and commercial lending. So perhaps they're shifting their focus to segments that are perceived as less volatile, potentially lower default rates.
Okay, so instead of chasing, those big ticket corporate loans, they're spreading their risk a little bit more across a wider base of borrowers.
Yeah.
But no matter who you're lending to, there's always the question of asset quality, right? Like how many of those loans are actually going bad?
Yeah, that's the big question that everyone wants to know the answer to. And HDFC's gross non-performing assets, or NPAs as we call them, ticked up slightly to 1.42%. Now, anytime I hear non-performing assets, I get a little bit
Oh,
nervous.
yeah, that doesn't sound good.
Well, it's something to keep an eye on for sure. But it is important to note that if you exclude the agricultural segment, NPAs remain stable at 1.19%. And agricultural loans are just inherently riskier. They're exposed to weather patterns, crop prices, things like that.
So sometimes those things are out of their control, right?
Exactly.
Okay, so slight uptick overall, but holding steady in most areas. Does HDFC's, history give us any clues about how good they are at managing these kinds of risks?
Well, they've got a pretty good track record compared to some of the other banks in India. They're known for having pretty robust risk management systems, and they're generally pretty conservative in how they set aside provisions for potential losses.
Okay, so hopefully they've got things under control. Now, before we go, too deep into all of the standalone numbers, I want to talk about something that really piqued my curiosity, which is HDFC's subsidiaries. I mean, it's almost like they've got this whole other universe of businesses beyond traditional banking.
It's true. They've got a life insurance company, a general insurance company, an asset management company, an NBFC. And, for those who aren't fluent in finance jargon,
Wow.
NBFC stands for non-banking financial company. And they've even got a securities brokerage firm.
Yeah, it's crazy. It's like they're not just a bank, they're like a financial services powerhouse.
Right.
And let's start with HDB Financial Services, their NBFC. Their loan book grew by an impressive 22% year on year, and they're maintaining a really healthy gross stage 3 asset ratio of 2.2%, which basically means that a very small proportion of their loans are considered to be high risk.
Yeah, that's really impressive. And it shows that they're not just growing for the sake of growth. They're doing it in a way that's responsible and sustainable.
Right, so they're not just like throwing caution to the wind.
No, they're not.
And their net interest margin of 7.5% suggests that they're doing a good job of pricing those loans. Okay, HDB Financial Services, clear winner there. What about HDFC Asset Management Company? They're the behemoth with $7.9 trillion in assets under management.
Yeah, they're a giant in the asset management space, and their profits surged by 31% this quarter.
Okay, so they're clearly doing something right in a challenging investment environment. So it seems like HDFC's strategy of, diversifying into these various financial services sectors is really paying off. I mean, it gives them a buffer against volatility in any one market, and it strengthens their overall position.
Absolutely.
So it's not just about being a bank anymore. It's about being, this one-stop shop for all your financial needs. But does this sprawling empire come with any drawbacks? Could it be a case of them spreading themselves too thin?
I think that's a really good question, and it's something that we want to keep in mind as we continue to analyze HDFC's performance. But for now, let's move on to a deeper dive into their standalone numbers, looking beyond the top-line figures to see what's really driving their profitability and where the potential risks might lie.
Sounds good to me. I'm ready to put on my, my financial detective hat and uncover the hidden stories within these numbers. So stay with us as we explore HDFC Bank's Q3 FY25 results in even more detail. Welcome back to our deep dive into HDFC Bank's Q3 FY25 performance. Last time we started uncovering some pretty fascinating details about their strategy and those impressive subsidiaries.
Right, and we kind of left off wondering if HDFC might be spreading itself too thin with, this very diverse business portfolio.
A valid concern. But before we get to that, I want to circle back to something we touched upon earlier, which was asset quality. Remember that slight uptick in gross NPA is 1.42% overall, but holding steady at 1.19%, excluding the agricultural segment.
Right, and I think what's really interesting is if you go beyond just looking at that final number and you look at their presentation slides, they actually break down how those NPAs moved over the quarter. So you can actually see the dynamics at play.
So it's not just about the snapshot. It's about the whole movie.
Exactly. They start the quarter with a certain level of NPAs. Then you have new slippages, which are loans that turn bad during the quarter. But then you also have upgrades and recoveries.
Right, so some are getting better, some are getting worse. It's like a constant flow.
It is a constant flow. And by analyzing, the trends in those movements, we can get a better sense for, the underlying health of the loan book. Are slippages outpacing upgrades and recoveries? If so, that could be a sign of trouble.
Okay, so we really need to understand the movement behind the numbers. And that applies to, other metrics as well, right?
Absolutely. Take credit costs, for example.
Mm.
HDFC provided a very detailed breakdown of their credit costs,
Yeah.
which are basically, the expense that a bank incurs due to credit risk. So it includes provisions for potential loan losses and actual write-offs. Think of it as, the cost of doing business and lending.
Got it. So how do they do? Are they, racking up huge expenses to cover bad loans?
Well, their credit costs for Q3 were 0.5% of advances, which was up slightly from the previous quarter, but still within a manageable range. And it's interesting, they also showed how that cost breaks down into, specific provisions, contingent provisions, floating provisions, general provisions.
Okay, now you're getting a little bit technical for me.
Yeah.
Can you kind of demystify what those different types of provisions are?
Sure. So specific provisions are set aside for loans that are already showing signs of stress. Contingent provisions are more like a safety net for, potential future losses. Floating provisions are kind of adjusted dynamically based on the overall risk environment. And general provisions are like a blanket reserve for any unforeseen losses.
So they're basically building multiple layers of protection to kind of cushion the impact of any potential defaults.
Exactly. It's a very prudent approach to risk management.
Yeah, that seems very sensible. Okay, so let's shift gears a little bit and talk about profitability.
Hmm.
Beyond just the raw profit numbers, there are two key metrics that I always look at. Return on assets ROA and return on equity ROA.
Yeah, those are important ones.
Now, I remember from my finance classes that, ROA measures how efficiently a bank uses its assets to generate profit, and ROE focuses on shareholder returns. So basically, how effectively are they using their resources to make money for themselves and for their investors?
Exactly. And HDFC Bank reported an ROA of 1.87% and an ROE of 14.1% for Q3, which are actually considered to be pretty healthy figures by industry standards.
Okay, so they're making money, they're managing risk. Are there any red flags in these results? Anything that makes you nervous?
Well, one area that might raise some eyebrows is the slight dip in their CASA ratio.
CASA ratio. Now remind me what that is again?
So CASA stands for current account savings account,
Yeah.
and these are deposits that are relatively low cost for banks because they don't have to pay high interest rates on them. So a high CASA ratio is generally considered to be desirable. HDFC's CASA ratio slipped to 34%, down from 35% in the previous quarter.
Okay, so a lower CASA ratio means that a higher proportion of their deposits are the more expensive kind, which could potentially squeeze their profit margins. Is this something to be concerned about?
It's definitely something to monitor.
Yeah.
This dip in the CASA ratio could put some pressure on their net interest margins going forward, especially if interest rates start to rise. So they might need to focus on, attracting more of those low-cost CASA deposits or finding other ways to offset a potential margin squeeze.
Interesting. So even in a seemingly positive report, there are these subtle hints of potential challenges. It's like a financial detective novel. You're uncovering clues along the way.
That's a good way to put it.
Okay, so let's go back to those intriguing subsidiaries that we were talking about earlier.
Mm.
Their performance kind of adds another layer of complexity and, frankly, excitement to these results.
It really does.
Let's start with HDB Financial Services, their NBFC. Not only are they growing rapidly, but they're also maintaining excellent asset quality. That 2.2% gross stage 3 asset ratio is a testament to their, prudent lending practices.
Yeah, it really shows that they're not just chasing growth at all costs. They're doing it the right way.
Yeah, it's like a perfect blend of ambition and caution.
And their net interest margin of 7.5% also indicates that, they're pricing their loans effectively. So all signs point to a very well-managed subsidiary that's contributing significantly to HDFC Bank's bottom line.
Okay, HDB Financial Services is a clear winner. What about HDFC Asset Management Company? I mean, they're the giant with $7.9 trillion in assets under management.
Yeah, they're a behemoth and they continue to impress. Their profit surge of 31% this quarter really speaks volumes about their ability to, to navigate the complexities of the investment landscape.
It's like they have the Midas touch. Everything they touch turns to gold.
Yeah.
But are all of HDFC's subsidiaries doing this well? Are there any, underperformers in the mix?
While most of them are doing really well, there are a few that are facing some headwinds. For instance, HDFC Ergo General Insurance saw their gross written premium decline by 29% year on year.
Wow, that's a significant drop. What's driving that decline? Are they losing market share?
It could be a sign that they're facing some challenges in a very competitive insurance market. Perhaps they're struggling to attract new customers or retain their existing ones. It's a good reminder that even within a diversified portfolio, some businesses will inevitably face tougher conditions than others.
It's like a microcosm of the economy, right? Some sectors are thriving while others are struggling.
Exactly. But, the key is to have that balanced portfolio, a mix of winners and those that are facing challenges.
Right, and that kind of brings us back to the question we posed earlier. Is HDFC spreading itself too thin?
Yeah.
Could managing, this complex web of subsidiaries actually become a distraction from their core banking business?
That's a valid concern. On the one hand, this diversification provides a buffer against volatility in any one market. But on the other hand, it does add complexity, and it requires a very skilled management team to keep everything running smoothly.
Yeah, it's a tough balancing act, but so far they seem to be managing it pretty well.
They do seem to be managing it well. They're demonstrating resilience in a challenging economic environment. They're leveraging their digital capabilities, expanding their reach, and benefiting from, the strength of their diversified businesses.
It's a lot to juggle. But they're doing it with a certain amount of finesse.
Yeah.
But remember, we're only looking at a snapshot in time. There are always, external factors that could come into play that could impact their performance in the future. Interest rate movements, regulatory changes, global economic events. All of these things can kind of throw a wrench in the best laid plans.
You're absolutely right. The future is uncertain. But based on these results, HDFC appears to be very well positioned to navigate those challenges. They've got a strong foundation, a diverse portfolio, and a clear focus on both digital innovation and customer service.
So while we can't predict the future with absolute certainty, we can say that HDFC is entering the next quarter with a lot of momentum and a strong track record. But one question that's still lingering in my mind is how will this legacy banking giant, with its, thousands of branches and its deep roots in traditional banking, how will it adapt to this rapidly evolving world of digital finance?
That's the million-dollar question, and it's the one we're going to be exploring in our final part. So join us as we delve into the future of banking in India and how HDFC is positioning itself to lead the charge in this very exciting new era.
Welcome back to the deep dive. We've spent this episode unpacking HDFC Bank's Q3 FY25 results, going from their consolidated performance all the way down to those intriguing subsidiaries.
Right, and we kind of ended part two with a big question, which is how is HDFC, this very traditional banking giant, going to adapt to this rapidly changing world of digital finance?
Right, because on one hand, you've got this global trend of digital disruption. Fintech startups are popping up everywhere. Mobile-first banking is all the rage, and everyone's predicting this branchless future.
Yeah, it seems like the writing's on the wall for branches.
Right, and yet HDFC is continuing to expand its physical footprint. They have over 9,000 branches, and they're still adding more. It just seems counterintuitive in this day and age.
Yeah, it does seem like they're going against the grain a little bit. But I think they may be playing a smarter game than it appears at first glance. Instead of viewing digital and physical banking as this either-or proposition, they seem to be embracing this both-hand strategy.
So it's not about abandoning branches, it's about reimagining their role.
Exactly. So think of it as, evolving from transactional hubs to relationship centers. Instead of just, cashing checks and updating passbooks, branches become places where you go for personalized financial advice, complex product discussions, really building that crucial trust factor.
That makes a lot of sense, especially in a country like India, where, digital literacy varies widely and people's comfort levels with technology differ across, different generations and demographics.
Right. A one-size-fits-all approach just isn't going to work in a market like India.
Right. HDFC seems to be recognizing this and creating what some call a phygital model, seamlessly blending the physical and the digital realms.
Yeah, I love that term, phygital.
It's very catchy.
It really captures the idea that we live in a world where both online and offline experiences are important.
Right. It's about giving customers the choice.
Right.
Right. Like if you need to do a quick balance check or a simple transfer, you can use the app. But if you're planning for retirement or you're, applying for a complex loan, you might want to go into a branch and have that face-to-face interaction.
Exactly. And HDFC is really uniquely positioned to execute this strategy because, on the one hand, they have invested heavily in their digital capabilities, but they also have this deep understanding of the Indian market built over decades of serving customers, all across the country.
Yeah, that's a powerful combination. They're not just, throwing technology at the problem. They're really using it strategically to enhance the customer experience, both online and offline.
Right.
This brings up an interesting point, though. What does this phygital approach mean for financial inclusion in India? Can it help reach those underserved populations and bring them into the formal banking system?
That's a really important question. And, while digital banking has made great strides in extending financial services to remote areas, there's still, significant hurdles to overcome.
Absolutely. Lack of internet access, low digital literacy,
Right.
and sometimes, just a general mistrust of technology.
Exactly. And that's where HDFC's extensive branch network, and particularly in those semi-urban and rural areas, can really play a vital role. They can act as on-ramps to financial inclusion.
So they can introduce people to basic banking services,
Hmm.
build trust, and then, gradually guide them towards those digital channels as they become more comfortable and confident.
It's a journey, not a destination.
This conversation has really challenged my own assumptions about the future of banking. I was so focused on this, digital disruption narrative that I totally overlooked the enduring value of human connection and, having that local presence.
It's easy to get caught up in the hype of the latest tech trends. But HDFC is showing us that, the future of banking is not about replacing one with the other. It's about creating this harmonious blend, this kind of best of both worlds scenario.
Yeah, it's like they're building a bridge between the traditional and the modern, ensuring that no one gets left behind as the financial landscape transforms.
It's a powerful image, and as technology continues to evolve, and who knows, what innovations are just around the corner, HDFC seems to be in a very good position to adapt and stay ahead of the curve.
That's the hallmark of a truly successful company, isn't it? The ability to embrace change while staying true to its core values. So as we wrap up this deep dive into HDFC Bank's Q3 FY25 results, what's the key takeaway for our listeners today?
I think the key takeaway is this. Don't just look at the numbers. Look
Yeah.
deeper. Understand the strategy, understand the vision, and understand the potential impact on people's lives. Because at the end of the day, banking is about people.
It's about helping individuals and businesses achieve their financial goals and aspirations. And HDFC Bank, with its unique phygital approach, seems to be finding that sweet spot between technological innovation and human connection.
They're really paving the way for a more inclusive and dynamic future of banking in India. It's going to be fascinating to watch how this story unfolds in the years to come.
And on that note, we'll wrap up this deep dive. Thanks for joining us. And until next time, keep exploring, keep learning, and keep asking those thought-provoking questions.
Goodbye.
See you next time.